Okay, so for those who have just joined us, we're here for a little talk with Glenn May Anderson, president of FDS Brokerage Services. Maybe to start, you can tell us a little bit about yourself and your company, and then we'll get into what's going on with the mortgage industry.
Certainly, yeah. We're a large, full-scale and full-service mortgage brokerage. We're actually based in Mississauga. I'm a Bellevillian, so I go back and forth during the week. I get very involved with the National Mortgage Brokerage Association as well, Mortgage Professionals Canada. I sit on their National Education Committee, their Ontario Broker Council. And we help lots of people, who normally can't find the right financing for their homes, go out there and get the right financing they need for their homes, just like a regular mortgage broker does.
Right. Yeah. So your market is obviously very different than what's going on in Belleville, and so one of the things that we wanted to talk to you about today is how you feel it's going to affect the Belleville market, given the fact that we're so different in prices and economy than Toronto, Vancouver, that sort of idea. So maybe explain a little bit about what you feel is going on with the industry and what this is all about.
Yeah, it's kind of a puzzling thing. Normally, the industry is consulted whenever they want to put changes in place like this. We have a number of different factors that are in place here. We all hear stories about prices skyrocketing in Toronto and Vancouver. But other markets across the province, Belleville in particular, is a pretty normal and balanced real estate market. It's chugging along and doing the right thing. I think the problem is that the federal government is concerned that too many people are getting into houses that they maybe can't afford, and the ghost of 2008, what happened in the U.S., for anybody who saw the movie The Big Short, the Canadian government's concerned there might be some real estate bubble or some massive mortgage crisis and mortgage crash. The problem is that instead of them taking a surgical scalpel and just trying to work on what the problems are in Toronto and Vancouver, this is a federal initiative that impacts everyone, so it's kind of like killing an ant with a sledgehammer. What they're really doing is changing the mortgage rules for everyone, and the impacts are going to be felt in smaller communities like Belleville, I think a lot harder than they are in markets like Toronto.
So maybe get into a little bit about how that impacts. So for instance, we know in this area the average house price is around the $250,000 mark.
Yeah.
So maybe talk a little bit about how that impacts on the type of income that you would need and the type of mortgage payment you'd have to do and how you qualify now.
Sure. I think it's important to step back and just mention that in the United States, the default rate, so the percentage of people that don't make their mortgage payments, is around the 5 to 6% mark. So that's 5 to 6 people out of 100. In Canada, the default rate for mortgages is 0.24%. That's 24 people out of 10,000 that default on their mortgages. So first of all, it's important to know you can't compare the U.S. market to the Canadian market. Secondly, in a larger market like Toronto, where your average house price is, condos are $650,000, $700,000, where your average full family home price is over $1 million. Are there people getting into the market that maybe don't have the resources? Yeah, I mean, I think there are people that are just scraping by. Reminds me of the early 80s when people were house poor. They had these great houses, but only had enough furniture, could only afford enough furniture for 1 or 2 homes. So, yeah, there's a challenge in the market in that there are some people that shouldn't be getting into the market. But where it's really different in Belleville compared to Toronto is the dollar value impact of those changes. So I'll give you an example. What they're going to do is make sure that and it's effective immediately. These rules were announced about 2 weeks ago, but all the non-bank lenders have basically stopped taking any applications under the old rules. If you apply for a mortgage and you don't have 20% down, so for a $250,000 house, if you don't have a $50,000 deposit to put down on that, you're going to have to qualify for that 5-year mortgage at what they call the Bank of Canada benchmark qualifying rate. Now, that's an average of the posted rates of the banks, and anyone who shopped for a mortgage knows that the posted rate is usually much higher than what the actual rate you can negotiate is. So right now, I think the 5-year Bank of Canada qualifying rate is about 4.64%. What this means is that if I'm a first-time home buyer and I had 5, 10, 15% down to put on a home, 2 weeks ago I could have walked into a mortgage broker's office or even walked into a bank and said, I've got 5, 10, 15% down. They would have qualified me at 2.49%, 2.39%, and that would have been my payment and everything would have been fine. What's happening today is if you go in and apply for that same mortgage, no matter where you are, if it's a 5-year term, 5, 10, 15% down, you're going to have to qualify at 4.64%. So what the impact is in a market like Belleville, where the average price is $250,000, it's going to take your mortgage payment, all things being equal, it means the amount of mortgage payment you can afford per month goes down by about $300 per month.
Right.
So instead of about a $1,400 mortgage payment, it's about an $1,100 mortgage payment. But more importantly, it means you can't afford as much house. So if you can only afford an $1,100 payment now, you can't afford a $250,000 house, you can only afford a $200,000 house. Okay, and more importantly, if you needed to have a $34,000 income to put 5% down and buy a home for $250,000, now your income has to be $43,000. So it's a really severe impact in smaller communities. And again, the government's doing this because they're worried about how people will deal with increases in payments. I can understand that, but if your home is worth $800,000 in Toronto and your mortgage payment goes up, because rates go up 2%, the dollar impact on you is enormous. If the dollar impact on someone who makes $35,000 a year, yes, percentage-wise it's the same percentage, but the dollar impact means you have to make $3,600 more per year towards those mortgage payments. So it's easier to make that transition. It really is being unfair to people in smaller markets, taking away some of their buying power. It'll remove about 20% of people from the market in the first place. And in general, it's about a 20% reduction in the buying power for the average consumer.
Now, one of the questions that we've been getting from a lot of people, and maybe you'll be able to address this, is how does it affect people that are doing refinancing? How does it affect people that are doing renewals?
Yeah.
For instance, they're in a home now and they know that their mortgage is coming due. How does that impact them?
So this is interesting because this is where I like to call these rules unintended consequences. This is where it's unfortunate that the finance minister didn't really talk to a bunch of people that are out in the mortgage industry. And it's interesting because Minister Morneau backtracked last week and said, oh, we're listening to what everybody has to say and we'll make adjustments as we need to. This is after they announced what the rule changes were, because I think they understand that they didn't necessarily understand all the consequences. If your mortgage is with a non-bank lender, the biggest change has to do with something called portfolio insurance. So I talked about that US market and the Big Short and what happened back then. In Canada, if you're a non-bank lender, it means you don't have deposits. You don't have people have savings accounts or GICs or what have you. You don't have money that you can turn around and lend to other people in a mortgage. And so you have to get your money in what's called the mortgage-backed securities pool. You have to get it in the capital markets. And in Canada, the law states that if you're a non-bank lender, you go out and lend that out, you have to pay for what's called portfolio insurance to insure all of the mortgages in there when you sell them back into the marketplace. It's kind of like when you buy a house, if you have less than 20% down, you have to pay for CMHC or Canada Guarantee or Genworth, you have to pay for mortgage default insurance. So it's the same principle, except it's these lenders that make those payments. Well, the problem is the rule changes that they've made that go into effect on November 30th only impact non-bank lenders that play in this pool. It doesn't impact the banks. So what they've done is effectively reduced competition, because now if you're first of all, if you're going to refinance your house, or you're trying to get a house and trying to get a mortgage from a non-bank lender, your beacon score, which is your credit score, has to be over 600. Your total debt service ratio, which means the percentage of your income, your gross income that goes towards all of your housing costs, has to be 39% or less. You can only amortize for 25 years. You can't go above 25 years in an amortization, and you have to live in that house. You can't use it for rental properties. So if you have a mortgage today with a non-bank lender that you got through a mortgage broker, when your mortgage comes up for renewal in a year or two, you could be facing higher rates. Because if your mortgage no longer qualifies under the new rules, the challenge is you'd have to, if you wanted to move your mortgage someplace else, you'd have to requalify at the 5-year rate that the Bank of Canada sets. So you may not have as much buying power, and you might not be able to move your mortgage someplace else. And if you stay where you are, if your mortgage doesn't fit in that new box that they've created, rates will go up, because those non-bank lenders still have to sell those mortgages in the capital markets, but the only place they can now sell them to is the banks. The banks are the only ones that can buy them, and the cost for buying those will go up, which means those costs will be passed along to the consumer. In general, the impact is probably going to be an artificial increase in interest rates between 0.5% and 1% over the next year. And that's not driven by the market, that's just driven by these policies the government's put in place.
Right. Okay, perfect. Is there anything else you think the Belleville market should know about what's happening in the next few months?
Well, there's not a lot you can do now, because the first set of changes went in place on October 17th. But I would definitely get on the phone to MP Neil Ellis and let him know, hey, these changes haven't really been well thought through. There needs to be some more consultation with the place in the first place. when you have economies like ours, the economy of Canada, 20% of our economy is based in real estate. We know what happened to Alberta when the price of oil went down. Now you're talking about trying to stifle 20% of the marketplace across the board. I don't disagree that changes need to happen to fix the Toronto and Vancouver markets, but you're going to impact smaller communities like Belleville in a way that's not intended. So I'd let Member Ellis know and let him know that these changes kind of really need to be taken a look at seriously, and you're going to have to start thinking a little more in advance about what you're going to do if your mortgage is coming up for renewal. You should still go talk to a mortgage broker, I believe, because mortgage brokers can give you unbiased advice from a bunch of different lenders, and we still have access to some of those banks. But it's important to start building a mortgage strategy for yourself so that you can make sure that you're not surprised when it comes time to renew or when it comes time to buy a house.
Great. Perfect. Okay, well, if anybody has more questions, feel free to get a hold of Tom or Tara at Team TaraLyons. We're here for you all the time, and we'll make sure we get your questions passed off to the people that know the answer. Glenn, thank you so much for taking the time on this. It's a Saturday, it's a beautiful day, and you still took the time to be able to do this with us, so I really appreciate it.
It's important. I think people need to know how it's going to impact them, and they need to get involved and start working with their real estate and their mortgage professionals to plan what they're going to do.
Perfect. Thank you so much.
You're welcome.